Stop scrolling, because the uranium story you are hearing right now is being told in a way that makes it sound calm, orderly, and priced in. And that is exactly how people get blindsided. The market is acting like the next few years are predictable. They're not. And the moment the crowd finally realizes what's actually happening with supply, contracts, and power demand, the move won't be polite. It'll be violent, it'll be fast, and it'll punish anyone who waited for confirmation. Today is Tuesday, February 3rd, and right now it's 6:07 in the morning New York time. Comment what time you're watching this, because I want to see where the real ones are tuning in from. Quick thing, and keep it simple. I'm running a campaign to eliminate copycat channels. If you value what I do here, hit subscribe and comment Urjanag so I can spot the community that's actually paying attention. Alright, let's get into it, because this is one of those markets where the headlines distract you while the real story is moving underneath the floorboards. We've had a choppy start to the year in the broader markets, and you can feel that nervous energy everywhere. Stocks jump, stocks dump, people panic, then they pretend they didn't. But uranium doesn't care about your daily mood swings. Uranium cares about one thing: can the world get enough fuel, on time, in the right form, under the right rules, to keep reactors running without paying up or cutting output? Let me slow that down, because on time is doing a lot of work in that sentence. Utilities don't buy uranium the way you buy groceries. They buy it with long lead times, strict specifications, and contracts that are written to survive decades. When those contracts are light, the market feels sleepy. When those contracts start getting signed aggressively, the market wakes up because the real volume is in the term market, and the term market is where the pressure builds quietly. Here's the part that should make you sit up. When a utility signs a long-term deal, it isn't just buying a commodity, it's buying certainty, and certainty has a premium, especially after you've watched supply chains wobble. That's why a normal price model can fail in this space. The buyer isn't optimizing for the cheapest pound. The buyer is optimizing for not being the headline that says, plant forced to cut output. And when buyers optimize for safety, prices don't creep, they gap. And there's another layer most people ignore: inventories. For years, inventories got drawn down because it was easier, it was cheaper, it was politically convenient. But inventories aren't infinite, and they aren't evenly distributed. Some utilities are comfortable, some are exposed, some countries are building buffers for strategic reasons, and when you combine that with a tightening fuel cycle, you get a market where a small change in behavior can create a big change in price. That's the setup, and I'm going to say something that might annoy both the bulls and the bears. Bulls sometimes talk like a supply deficit guarantees a straight line up. It doesn't. Bears talk like any pullback proves the thesis is fake. It doesn't. What you actually have is a market that reprices and bursts because the participants behave differently. Utilities move slowly, then they suddenly get serious when their coverage window gets thin. Financial players chase momentum, then step back when volatility spikes. Junior explorers can rip higher on a few drill results and then get punished when risk appetite disappears. That doesn't invalidate the geology. It just reminds you what game you're playing. If you remember the mid-2000s uranium spike, you remember how fast nobody cares turned into everyone cares. If you remember the post-Fukushima era, you remember how long a market can stay depressed even when the long-term need doesn't go away. This cycle has ingredients from both. You have structural necessity and you also have fragile sentiment. That combination creates shakeouts that feel terrible in the moment but often end up being the handoff before the next leg higher. The lesson is simple. Volatility is not the enemy if your position sizing is sane and your thesis is grounded. Now, I know what some of you are thinking. Uranium is volatile? Yeah, that's the point. Volatility is the symptom, not the disease. The disease is that the system was built for an era when nobody wanted nuclear, and now we've quietly shifted into an era where everyone wants nuclear. At the same time, for different reasons, with the same limited supply chain. That's where the tension comes from. And the best part, if you're positioned correctly, is that most investors still don't understand the plumbing behind this market. So here's what I'm going to do in this video. First, I am going to frame what is driving this uranium bull market in a way that actually makes sense, not in a way that makes you feel comfortable. Then I'm going to explain why the easy fixes people keep talking about are mostly fantasy, at least in any time frame that matters to normal investors. After that, we're going to talk about the AI and data center narrative and why it matters, but also why you shouldn't be tricked into thinking it's the only reason this is happening. Then we'll pivot into US policy and why the fuel chain is becoming a national security issue. And finally, I'll bring it down to the ground level with a real-world exploration setup, what to watch, what to ignore, and what can change the valuation in a heartbeat. And yes, the description has bonus links for you. There's a premium WhatsApp channel link if you want quick updates when something breaks. And there's also a channel membership join link if you want the stuff. Now, before we zoom into the weeds, let me give you the big picture in plain English. The uranium market isn't like oil. You don't just pump a little more next month and smooth things out. Uranium has a long chain. You find it, you permit it, you mine it, you process it, you convert it, you enrich it, you fabricate it, you qualify it, you deliver it, and then you load it into reactors that can't just switch fuels because a politician made a speech. That chain was neglected for a long time, and you can't rebuild it on vibes. Based on recent market updates, the spot price has reminded everybody that this market can reprice quickly when the incremental pounds dry up. But the spot price is the loud part of the story. The quiet part is contracting. The quiet part is utilities looking at their inventory windows and realizing the calendar is not their friend. The quiet part is that the most important purchases often happen without drama until one day there is a scramble and then everyone acts surprised. So what are the main catalysts right now? The first one is the obvious one, power demand. Not nice to have demand, real demand. The kind of demand that shows up when grids are stressed, when electrification policies collide with reality, when aging infrastructure meets growing populations, and when industries that used to run on fossil fuels are being pushed toward electricity. And here's the twist, renewables help, but they don't solve baseload. They don't solve winter nights, heat waves, or industrial demand that can't pause because the wind took a day off. The second catalyst is that governments are treating nuclear less like an embarrassment and more like an asset that matters. Not because politicians are wise, but because permitting, incentives, and strategic stockpiles can change the pace of projects. And the third catalyst is supply fragility. People hear supply deficit and they imagine a simple gap between a demand line and a supply line. No, in uranium, the deficit is a moving target with multiple layers, and when one layer slips, it creates a chain reaction. Here's where I'm going to challenge a popular take. A lot of people say the market is tight because a couple of big producers had setbacks. That's true, but it's incomplete. The deeper reason the market is tight is that the system was kept alive for years by secondary supplies, inventory drawdowns, and a general lack of urgency. When nuclear was unpopular, utilities could coast. They could buy later, they could take risk. They could rely on a pipeline of material that felt endless. Now the urgency is back and the pipeline doesn't look endless anymore. Now imagine this. You have large producers that are supposed to provide stable pounds, and even they face delays, grade variability, technical issues, labor constraints, and the kind of operational surprises that never show up in the glossy investor deck. Then you have geopolitical risk layered on top, trade restrictions, sanctions, sudden policy moves, and the fact that certain parts of the fuel cycle are dominated by countries that are not exactly aligned with US interests. And then you add the reality that new mines take years, not quarters. This is why the market can feel calm right before it snaps. And this is why I keep saying the surprise factor is almost always negative. Projects don't usually come in early and under budget. They come in late and expensive, and in a market like this, late isn't just annoying. Late can mean utilities are forced into the spot market, or forced into unfavorable contract terms, or forced to pay up for security of supply. That's when the narrative shifts from interesting sector to strategic scramble. And when that happens, the equities don't move like a normal stock chart, they move like a pressure valve. Now let's address the elephant in the room, the AI data center story, because it's everywhere. And if you're not careful, it will either make you chase at the top or panic at the wrong time. Here's the truth. AI is real. Data centers are expanding, power demand is rising, and tech companies have the money, the urgency, and the PR incentives to lock in long-term energy deals. Nuclear fits that storyline because it's clean on paper and steady in practice. So yes, it brings attention, it brings capital, and it brings momentum. But here's what I want you to remember. Uranium didn't need AI to be a bull market. The bull case existed before the data center headlines. The deficit dynamics, the contracting cycle, the underinvestment, and the fuel cycle constraints were already enough. AI is gasoline on a fire that was already burning. And that distinction matters, because if the market gets spooked by an AI headline, maybe a model becomes more efficient, maybe a company delays a build-out. You can get a temporary dump in uranium equities that has nothing to do with the long-term supply reality. And speaking of narratives, let's talk about small modular reactors. SMRs are the shiny object, they make for great speeches. They make for great investor presentations, but the reality is that most SMR timelines are long, complex, and regulatory heavy. Some projects will work, some will stall, some will morph into something else. The key point is that even if SMRs take longer than people hope, nuclear life extensions and large reactor builds are already pulling demand forward. The baseline demand story isn't waiting for futuristic tech. It's already here. Now, a lot of you ask me, okay, but what does higher uranium price actually do? Because some people think it's just a chart game. It's not. Higher price changes behavior. It changes which projects get financed. It changes how utilities negotiate. It changes how governments think about strategic stockpiles. And it changes the leverage in the equities. Because miners and developers don't move one for one with the commodity. They often move like a spring that's been compressed. But here's the nuance. Not every company benefits equally. Some producers have legacy contracts that cap upside for a while. Some developers need higher prices just to justify building. Some explorers live and die by market sentiment because they don't sell pounds yet. And in the middle, you have the almost there names that can get re-rated massively if they move from story to shovel-ready. So the smart question isn't, will uranium go up? The smart question is, where is the mispricing of timing and optionality? According to the latest publicly available filings in the nuclear build-out ecosystem, you can see long lead equipment orders and life extension work that signals commitment. That matters because nuclear isn't a fad. Once a reactor gets a life extension, it's basically a statement. We're staying in the game, and staying in the game means ongoing fuel demand that doesn't care about the flavor of the month narrative. Now let me give you the cliffhanger that ties this all together. If the market gets one more visible supply surprise, one more delay, one more cut, one more policy shock, the conversation changes overnight. The media won't lead that change. Price will, contracts will, and then suddenly the same people who told you it is too late will be the ones chasing because the fear of missing out becomes bigger than the fear of volatility. The question is whether you'll already be positioned when that shift happens, and just to keep it honest, there is one bearish argument that deserves respect. If governments overpromise and underdeliver on nuclear builds, the timeline for demand growth could stretch. But even in that scenario, the existing fleet still needs fuel. And the supply chain still isn't built for comfort. So the bull case doesn't require perfection. It requires the world to keep choosing reliability over wishful thinking. And so far, that choice keeps getting made again and again. Now here's the part that most people miss. Uranium demand is not just about how many reactors exist. It's also about how those reactors are fueled, what enrichment levels are used, whether countries are building strategic inventories, and whether utilities want more security margin after the supply shocks they've lived through. And when countries start talking about energy security, they don't do it quietly. They do it with policy, with incentives, with bans, with domestic supply chain plans, and with capital that suddenly has a mission. Which brings me to US policy. You've probably noticed a shift. One more thing about friendshoring and domestic policy. People assume policy only matters when it becomes law. That's not true. Policy changes behavior long before it becomes law. When agencies talk about rebuilding fuel capacity, when incentives are floated, when bans are discussed, companies start repositioning, capital starts flowing differently, permitting priorities change, partnerships form, and suddenly a district that used to be interesting becomes strategic. When that happens, the multiples can change, even before the first new pound hits the market. From recent market updates, you can also see that utilities and governments are thinking about security of supply with a new seriousness. That doesn't mean panic today. It means a higher willingness to sign longer contracts and a lower willingness to gamble on spot. And again, that quietly supports higher prices over time. The U.S. wants more nuclear generation. It also wants less reliance on unfriendly supply chains, not just for uranium itself, but for conversion and enrichment services. That's huge, because even if you have uranium in the ground, if your fuel cycle steps are bottlenecked or politically constrained, your real supply is limited. And when that realization hits, it changes who matters. For Canada, this is interesting. Canada isn't just a neighbor. Canada is one of the most credible, high-quality suppliers in the world, with grades and infrastructure that make projects competitive, especially when security of supply is a priority. So if the US is serious about reshoring or friendshoring its nuclear fuel chain, high-grade Canadian projects become more valuable strategically, not just economically. And that's the kind of shift that doesn't always show up in quarterly earnings, but it shows up in what gets funded. Now let's pivot because I want to bring this out of the abstract and into a tangible example. Imagine a junior exploration company operating in a top-tier jurisdiction, sitting in a district known for high-grade deposits. Their job is not to pretend they're a producer tomorrow. Their job is to find pounds, prove continuity, build a resource, and keep expanding the story while the market is rewarding discoveries. That's the game. And if you're new to this, let me warn you, exploration stories are not linear. You don't just drill, hit, and then magically become a mine. It's a progression of proof. You start with a discovery, then you step out, then you tighten up, then you model, then you publish a resource, then you test new targets. Along the way, you raise money, you deal with dilution, you deal with market cycles, and you deal with investors who only care when the price is already up. So in this example, the company made a discovery a couple of years ago and spent time expanding and defining it. They produced an initial resource estimate with strong grades and a high-grade core. That matters because high-grade cores can make economics dramatically better, and they can make a project more attractive to partners or acquirers, especially when capital is scarce and time is valuable. But here's the cliffhanger. A resource is not the end of the story. It's the beginning of a different story. And then, in this example, they didn't just sit on the first discovery. They found a second zone some distance away with a different geological signature than the textbook model. That's important for two reasons. First, it suggests the system can produce mineralization in multiple settings, which expands the target universe. Second, it proves the team isn't trapped by one idea. In exploration, being trapped by one idea is how you miss the next deposit. Now, when you hear that a new zone is not on a conductor, or not following the classic playbook, you might think that's bad. It can be. It can make targeting harder, but it can also mean you are early in understanding a new style of mineralization that other explorers aren't even looking for. And that's where a technical edge becomes a money edge. Because if you can see what others ignore, you can accumulate land, drill the right holes, and build value before the crowd shows up. And here's the valuation angle that people either misunderstand or ignore. In commodity cycles, the market tends to overpay for certainty and underpay for optionality until optionality becomes scarce. A producing asset with steady cash flow looks great when everyone is scared. A discovery story looks great when everyone is greedy. But the real money is often made when optionality is mispriced right before a scarcity narrative takes over. So when you look at an explorer with a high-grade resource and a new discovery zone, the question becomes, does the market value it like a lottery ticket or like a serious piece of a future supply puzzle? In many cases, it's valued like a lottery ticket until enough drilling de-risks the story. Then it gets valued like an asset. That transition is the re-rating. That transition is what you want to catch, not chase. Now here's the part I want you to watch closely, because this is where a lot of people get emotional when a junior hits good results. Investors start projecting perfection. They assume the next holes will be better. They assume the zone will be huge. They assume the company will get bought tomorrow. And when reality shows up, maybe a weak hole, maybe a complicated structure, maybe a delay, the stock dumps, and people act like the thesis is dead. That's not analysis. That's impatience. Exploration is probability management. The reason a strong team matters is not because they never miss, it's because they know how to learn quickly, adapt, and keep the drill aimed at the best odds. A strong technical team also knows how to avoid wasting money, and in a bull market, discipline is a superpower. So what should you be looking for in a story like this right now? You should be looking for step-outs that extend strike length. You should be looking for evidence that mineralization continues in multiple directions. You should be looking for alteration patterns that suggest proximity to the most intense part of the system. You should be looking for consistency, not just one spectacular interval. And you should be listening for whether management talks like adults or talks like salespeople. Adults talk about risk, probabilities, and plans. Salespeople talk about destiny. And now let me pull back to the uranium market again, because this is where it all connects. If the uranium price environment stays supportive, the market tends to reward discoveries more aggressively. But if the market gets a risk-off shock, juniors can get hit even if nothing changed on the ground. That's why you don't just buy a ticker. You buy a thesis and you size it like a thesis. And yes, I know that sounds boring, but boring is how you survive long enough to win. Also, a quick community moment. If you're successful, share your success story in the comments so others can stay motivated. I want this channel to be a place where people actually learn and improve, not just watch and forget. Now I want to address something that the uranium crowd sometimes underplays. The fuel cycle is not just about mining. Now let's get even more concrete about the bottlenecks, because this is where the market can surprise you. Mining is one constraint, but conversion capacity can be another. Enrichment capacity can be another. Fabrication and qualification can be another. And political constraints can hit any one of those steps. So when you hear someone say there's plenty of uranium, ask plenty in what form? In what location? Deliverable through what chain? Under what rules? A pound in the ground is not the same as a pound that can be turned into reactor-ready fuel on schedule. According to the latest publicly available filings from companies across the fuel cycle, you can see heavy spending and long lead orders, and that tells you management teams are preparing for tighter conditions ahead. And when the fuel cycle spends, it usually means the customers are pushing them to spend. That's not hype, that's planning. The market just hasn't fully priced the implications yet, and those parts of the chain can become choke points. If you've got a world where nations want a secure supply and certain segments are constrained or politically sensitive, you can get situations where uranium in the ground is not the limiting factor. A resource estimate adds credibility, a second zone adds upside, a strong treasury adds runway, and a clear plan adds confidence. That's the skeleton of the story. But you also want humility. You want management to admit they're explorers, not future billionaires. You want them to talk about what they don't know yet, because the companies that pretend certainty are often the ones that blow up when reality hits. In contrast, the companies that manage expectations and deliver surprises tend to build long-term trust. And I'll say it again because it matters. If you're successful, share your success. Story in the comments so others can stay motivated. You never know who's watching quietly and needs that push. Now, before I close, I need to mention something important for the people who want more depth. We do offer members-only videos. Those are produced by a separate team with more research and more time, and they're only available for premium members. If you want the deeper dives, the extra context, and the higher frequency breakdowns, check the channel membership join link in the description. And if you're still here, do me a favor, subscribe, because if you're watching this far, you're not casual, you're building an edge. And in a market like uranium, an edge is worth more than hype. So here's the bottom line. Uranium is not a simple commodity story. It's a power story, a policy story, a supply chain story, and a timing story. It's about what the world is willing to pay for reliability when reliability becomes scarce. It's about what happens when a neglected system is suddenly expected to carry a heavier load. And it's about whether you can keep your head when volatility tries to shake you out. The next few years could deliver the kind of moves that people talk about for a decade, or they could deliver a grind that tests everyone's patience before the real breakout. Either way, the people who win are the ones who understand the structure, not just the headlines. And finally, the standard but real talk. Everything you heard here is for educational purposes only. I'm sharing how I think through the market so you can sharpen your own process, not so you can copy trades or blame someone else for outcomes. Do your own homework, consider your own risk, and make decisions that fit your situation.